Market panel with the action. Joining us now is Payne Capital Management Senior Wealth Advisor and CNBC contributor Courtney Garcia and Vital Knowledge founder Adam Crisafulli. Guys, good afternoon. Courtney, after this huge first half we had for the S&P, still new highs. Give me your take on this market and why you see opportunity in Europe and bonds.
Yeah, and I mean, we've had a great market this year, and really anybody who's participated in that, you're really taking advantage, despite the fact there's so much cash on the sidelines right now. So a lot of people are not taking advantage of that right now. But I think the idea is inflation has been the big key in the stock markets. We continue to get good data recently, with whether it's the PCE numbers that came out on Friday, whether it was Powell speaking today, but it looks like inflation is still trending in the right direction, that there's now almost a 70% chance that the Fed will cut as soon as September, about a 95% chance they will cut sometime before December. And if interest rates do eventually come down, that is going to additionally be a boost for the stock markets. So you want to make sure that you're staying invested here. And especially bonds, which you mentioned, there's so much cash is on the sidelines here, and everybody's very happy with that paying 5%. But the second that interest rates go down, those are going to rate downwards, and you're going to see that safe money going back into bonds, and especially things like munis right now, which if you're in a high tax state like New York or California, those tax equivalent yields right now are very attractive, and you want to get in there now before rates go down. And that's something we're constantly talking to our clients about.
Yeah, New Jersey too, for sure. Well, speaking of fixed income, Adam, you point out that forces are pushing short-term bond yields down, long-term yields higher. What should investors do with that?
Yeah, so you've definitely seen on the economic front, you are seeing disinflation. You are seeing the Fed rhetorically prepare the market for a rate cut. It looks increasingly likely they're going to move at the September meeting. But I think offsetting that and what's pushing longer yields higher is the fiscal dynamics in the United States, which is really going to be, I think, the dominant macro theme towards the end of this year and then all throughout 2025, where Congress and Washington will have to make some huge decisions about the whether or not to extend the Trump tax cuts. You're already at a very unsustainable fiscal trajectory. This was something Powell was asked about today and talked a lot about. He said the absolute level of debt right now is okay. The market can handle that, but the trajectory, the deficits, are extremely elevated, and this is at a full employment economy, and that assumes that Trump cuts will expire as planned next year, and that's looking increasingly unlikely. So, and that's creating this curve steepening dynamic where the Fed is pinning short-end yields lower, but long-end yields are facing upside pressure because of fiscal dynamics.
I'm glad you brought that up, because it's literally the question I'm about to ask you, Courtney. And it does reference what Powell had to say in Sintra today to our own Sarah Eisen when she asked about this very topic. Have a listen.
The United States is running a very large deficit at a time when we're at full employment. And it just is, the level of debt that we have is not unsustainable. The path that we're on is unsustainable. That's completely non-controversial. I would have thought that this is something that should be a top-level issue. And you do hear this from a lot of elected officials.
I mean, it's interesting, right? Because inflation is what has been driving the narrative, particularly for the bond market, at least up until recently. But as one trader pointed out in a note today, you have a twist steepening afoot. So bullish 2-year yield down, bearish with a 10-year yield up, because you do have this tug of war between monetary policy on the one hand and fiscal policy on the other. Your thoughts?
Yeah, I think that's absolutely one of the biggest concerns is where we are in the deficit. And it's something that has to be addressed here at some point. So I think that's going to be a continuing and ongoing conversation. And what's also happening now is you're starting to see it getting more and more priced in that Trump is going to get elected in November. And obviously, a lot can happen between now and then. But the idea is if you do have Republicans in the House, the Senate, and on the presidential seat, you could actually see additional spending, plus things like tariffs, whether it's in Europe or in China, which actually could mean additional spending and keep those rates higher. So that's why, despite the fact those PCE numbers came in so strong last week, you are seeing those yields tick upwards. And it's an interesting dynamic we're seeing. And I think it's a little too early to trade on that, but it's something that I think is going to be this tug of war now through the end of the year.
It does raise the question, though, Adam, how sustainable is it? We know historically, and maybe on a lagged basis, but that equities tend to take their cues from the bond market. So what's the bond market signaling now? And have we seen a split between trading in these two different asset classes, or are they going to converge at some point?
Yeah, I mean, it's really interesting. We haven't really had a fiscal dimension to the narrative in decades. It's always been about monetary policy, at least since the great financial crisis. But we're now entering this new era where the Fed is going to be easing policy very modestly. It's not going to be an aggressive easing cycle. So that's going to happen in the near term. That is positive. But again, for the first time, you'd have to go back to the bond vigilantes in the 90s, where markets have had to contend with the effects of extreme fiscal policy or fiscal profligacy on deficits and yields. And so I think, that's really going to be a dominant theme towards the end of this year and into next year, where the longer end of the curve will stay elevated. You'll have this steepening effect. And whether or not that imposes some fiscal discipline on Washington, that remains to be seen. You're probably going to have to see yields go a lot higher before Congress would actually take note of it and act in response. But, I do think this will be, again, the dominant macro topic of conversation throughout next year.